Hello and welcome to this special edition. This is the last Monday report from Bourdier for the year 2025. The statistics published late last week in the United States confirm the downward trend in the job market. You can see that the US economy has created only 22,000 jobs on average per month over the past 3 months. Moreover, the unemployment rate has risen again to 4.6%, a high point in this economic cycle, whose low was 3.4% in the first half of 2023. These figures should also be considered alongside the historically low level of consumer confidence. Nevertheless, as you can see here, the year has been positive for most asset classes. Gold was one of our favorite assets and increased by 65% in dollars. Emerging market equities, which we are positive on, outperformed European equities. US equities returned 16%. But in dollars, which itself depreciated by 9% on average and by 13 to 14% against the euro and the Swiss franc. Conversely, it was US bonds that performed the best with an 8% return. This makes sense given the level of US interest rates and their downward trajectory. What are our views and positions as we enter 2026? Well, our views are differentiated depending on the regions and currencies. In the United States, we believe that with inflation almost under control, a slowdown in the job market, and the renewal of the Federal Reserve's presidency, US rates and yields will continue to ease. This is why we have a bearish view on the dollar and are overweight on fixed income bonds whose risk-adjusted yield is clearly higher than that of equities, on which we are slightly underweight. The situation is different in Europe, where, in our view, the central bank will not lower rates and where we are waiting for a cyclical recovery that will become more pronounced in the second half of the year. Here, our positioning is more balanced between bonds and equities, with a more cyclical and domestic bias. We also have a constructive view on equities in Switzerland, where, conversely, the risk-adjusted return is significantly more positive than that of bonds, for which the search for yield through alternatives and real estate remains preferred. Finally, we remain positive on gold, which in our view is not in bubble territory. Gold will remain a structurally beneficial asset in an environment of widespread monetary creation, and notably from the reduction in dollar exposure by emerging market central banks. In light of this central scenario, we are monitoring 4 risks in particular. Stagflation in the United States, meaning a significant deterioration in the labor market accompanied by high and persistent inflation. This is not our scenario at the moment. A disorderly unwinding of the Japanese carry trade in the event of repeated interest rate hikes by the Bank of Japan, at the same time as repeated rate cuts by the US Central Bank. Difficulties in financing the massive investments in artificial intelligence in the United States. It should also be noted here that the tech sector is not outperforming the market. Large cap stocks in the US over the past 3 months are up about 2.5%. And finally, a slip in the private credit market for businesses or real estate, where some signs of stress or discounting have appeared, if these were to spread to the financial system and the liquid financial market. We are not at that point at all today. As always, but now more than ever, diversification must remain a priority. We remain generally constructive as we approach 2026, but we will be ready to actively adjust our views and exposures. If either of these alternative scenarios were to materialize, that's all for today and for this year. Together with Gianluca and the entire investment team, we wish you a wonderful holiday season and a Merry Christmas to those who celebrate it, and an excellent year 2026.